Welcome, everyone. I'm Mike Brashazade.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey everyone, welcome to another exciting episode of the What Matters podcast, where we explore the world of finance and beyond. I'm your host, Mike Brashazade.
And I'm Ashley Ward.
And today we are thrilled to have a special guest joining us, James Pickert, Managing Director of Kanawha. Is that correct? Kanawha Capital Management. Kanawha. I knew I was going to, for some reason, I knew I was going to butcher that. With a last name like mine, I should have every pronunciation, down pat, but thank you there. Capital Management in Richmond, Virginia. Jimmy, welcome to our show today.
Thanks, Mike and Ashley, for having me. Glad to be here.
It's a pleasure to have you with us today, Jimmy. Let's dive right in. So let's start with your journey. How did you find your way into wealth management? And what experiences led you to your role now as Managing Director at Kanawha Capital Management?
Yeah, well, I've been in the industry for about a decade now, and I joined Kanawha roughly a year ago after working at another RIA in the Richmond area for between 8 and 9 years. And prior to working with that RIA, I got my start in the financial advisory training program at Merrill Lynch. And over the past decade or so, I'd say that trajectory has just been a journey of me figuring out, what do I see as the best model and the best way to serve clients in the industry, and what's the best fit for me? And so if you think about that progression, I left a pretty large brokerage firm in Merrill Lynch, where I felt like I was maybe a smaller cog in a larger machine. I wanted to have more of an impact. I wanted to see the consequences of the advice that we were giving to clients manifest more directly through direct relationships and being behind the scenes. And so that's what led me to leave and join that other registered investment advisory firm. And I enjoyed my time at that previous firm. Ultimately, when I saw this opportunity come up with Kanawha in late 2022, I reached out to them because they have a great reputation within the Richmond area and throughout Virginia, and working with clients nationally, not only for the high level of client service that Kanawha provides, but also just their investment approach much more closely aligns with how I think client money should be invested, and that's through the predominant investing of individual stocks and bonds without the addition of different types of funds that might carry extra layers within that experience for the client.
Really cool. So let me ask you this: you've been there for about a year now, correct?
Yes.
And so tell us a little bit about the company. You guys have, and again, you can correct me if I'm wrong here. We always get only public information. So you guys have grown the AUM to about $1.5 billion. Is that correct? During the duration that they've been in business?
Yes, that's correct. So this year is our 35th year in business. It was founded back in 1989, and the original founders migrated from the bank trust side of the industry, where they felt there might be some inherent conflicts of interest with that particular business model, into the RIA space, where they felt like they could really deliver a fiduciary level of service to their clients. And so that's something that even we current managers are proud of, that forward-looking thinking and being first movers ahead of that trend that we've seen over the past couple of decades, from the larger bank model to more of an RIA focused model. And so those managers, again, left in 1989. Ever since that, as time has elapsed, managers retire. The general trend has been that as a manager retires, we bring on a new seasoned advisor in order to help absorb capacity and make sure that we're sustaining the same level of service that our clients have come to expect. And so that was part of the reason for the timing of my joining Kanawha last year.
So how did you, grow into being a managing director in just 1 year of being at the firm there?
Part of it was by virtue of the fact that I've been doing a very similar role at that previous RIA for the better part of my time there. So I've been managing client portfolios. I've been working directly with clients in that client-facing setting, helping them with financial planning, helping them meet their financial goals. And so it was just a happy marriage, I guess you could say, where they had a need. I had the skill set developed over several years where I could plug in pretty seamlessly and beginning adding value in a relatively short order without the need to maybe hire a junior analyst that you would then need to train and help cultivate their skills before they could really step into that role.
And if you could talk to me about the growth, was the growth, did that come organically, inorganically? How did you guys get to your AUM, and was that growth that had happened since the pandemic, or has it been a slow growth all the way up throughout the last couple decades there?
So our growth has been strictly organic. We haven't really made any acquisitions. It's really just been a matter of finding high net worth families and individuals out there that have a problem that they're trying to solve or a need that we can help fill, and establishing a relationship with the families like that, building strong relationships. Many of our clients have been with us for decades now, and watching that intergenerational wealth grow over time, that's really been the way that we've grown our assets. And obviously, a very strong decade plus in the markets has been a tailwind for us as well. But we've seen plenty of organic growth just through word of mouth. Our clients like talking to their friends and family members about the work that we do for them. And so we've grown our business in that way as well.
Really cool. Thank you.
And so how many advisors are there right now?
So I'm one of 4.
Okay. And then how many employees total do you guys have?
So we have 11 total. So it's the 4 of us, and then we have 4 account administrators and then 2 operational employees. So I guess actually that's 10. I'm counting one of the advisors that retired at the end of the first quarter. So we're at 10 right now.
And how have you liked that transition, coming from a larger brokerage firm to having a small team?
Yeah, it was great. And I knew from day one that it was right for me. And, in truth, that transition really occurred from my move from Merrill Lynch to that previous registered investment advisor back in 2014. That was also a smaller company. But I knew once that opportunity arose that was just something that, from a personality standpoint, and also from how I wanted to craft my career, that would be a much better fit for me in the long run. And it would enable me to, retain the analytical side of doing investment due diligence and research, all that back office stuff that, we go get our CFA credential for, but also be able to be client facing and meet with the individuals that our investment decisions are impacting, because that was important to me as well.
Thank you.
Yeah. And so it really gives you more of an entrepreneurial aspect to your career. What are some of the most valuable lessons in that space that, you've learned throughout that transition in your career, and any advice for aspiring wealth managers looking to navigate and seize opportunities?
It might be cliche, but we really just focus on doing what's best for our clients. That's kind of our North Star, if you will. And we have found that just by doing that and always thinking about what's best for our clients, that everything else kind of sorts itself out in the long run. That's how we've been able to retain clients for as long as we have. We have very little turnover among our client base compared to the rest of the industry. And so that's, again, our North Star, and kind of our cardinal rule is just to make sure that we're always doing that. It's obviously the fiduciary rule, and you have an ethical responsibility to do it, but we find that it makes great business sense as well. I would say that, from an entrepreneurial learning standpoint, another key thing that I think really represents Kanawha's identity pretty well is that while on the one hand we are open-minded to change and we're always looking at fresh opportunities from different angles and looking for ways to improve our client portfolios and our technology suite and how our clients work with us. We also are always consciously exercising a lot of restraint. We're not always chasing that hot dot that's the next big trend, right? Whether it's from an investment standpoint or a service that other advisors might be offering their clients. Because what we've seen over the past 20, 25 years is that the industry has really seen a lot of innovation, and I think that's been for better and worse, right? And there have been some things, especially when we talk about on the investment side, products, strategies, investing trends that might be really compelling, and an advisor might naturally be drawn in to use something like that in order to impress their client or show their client that they're doing something new, when in the long run, that's not necessarily better for the client. And so we always ask ourselves, whose interest is this new idea in? Is it truly in the interest of the client, or is it in the interest of the firm or the person that developed that product? And if we don't understand it fully and feel that it's in that client's best interest, then we pass.
So switching gears a bit, I know you're a younger guy there, but you've obviously seen some, with markets being up 70% of the time, down 30% of the time, give or take. What would you say has been, the most challenging time in your career that you've seen? And how'd you navigate out of it?
I guess just to lump a few different periods into answering that question, I've found that the most challenging times for me are after the crisis has passed, whether that, and again, I'm relatively young, so I was not an advisor during the GFC, but I was in the industry for much of the 2010s. And then, of course, the pandemic caused bear market and the difficult markets that we saw in 2022. And I think any advisor worth their salt knows that when times are really tough, your clients want to be hearing from you. It's good to be proactive and reach out to your clients and let them know your perspective, let them know that there's a plan in place and why you should stick to it. And so that's kind of the obvious thing to do. That doesn't mean those times are enjoyable, but there's clarity on how you should engage with and interact with your client during those periods. It's after that storm has passed where I personally struggle, and I don't know that I necessarily still have a great answer to this. What type of engagement do your clients look for from you after they've heard from you, for example, 3 times in 6 weeks during the onset of COVID? Mm-hmm. Well, the market saw a V-shaped recovery, and so that April, May, and June, I think my clients were good. They didn't necessarily need to hear from me, but I still felt like I was walking the tightrope of, okay, well, I don't want to be too absent and too aloof, right? But I also don't want to bombard them with my presence, because a lot of our clients hire us to keep this type of stuff off their plate.
So building a thriving firm surely involves some secret ingredients. Can you tell us how your team manages to differentiate yourself in a competitive market, and what strategies have really been instrumental to position your firm that way?
Now, are you asking that question more from an operational standpoint, or when you refer to strategies, are you looking for more of an investment strategy?
I'd say both.
I'm
both.
thinking,
okay.
Yeah.
Well, I'll answer it operationally, and then I can speak more about our approach to wealth management. And I don't think there's necessarily any secret sauce there per se, other than just being disciplined, which is a characteristic and not necessarily a secret. From an operational standpoint, obviously we're in a knowledge work type service, we're in a professional service, and therefore, by definition, our biggest assets are the people that we have at our firm, the employees that we bring on. And so ever since, 35 years ago, long before I arrived at Kanawha, the firm has placed a really heavy emphasis on just hiring top talent and retaining that top talent. It's true both at the managerial level, where whenever they hire someone like they hired me last year, they want to identify someone out in the marketplace that has that experience and can step into the role and really begin adding value from day one, rather than someone that needs to learn the ropes. And over the long term. And then at the operational level as well, most of our staff have been with us for over 2 decades. And, I don't think that a lot of firms can make that claim. And we do that by just showing that we care about them. We listen to their feedback, and we show that we really want to see them grow within their individual careers. And that's not only a benefit because you're not spending a lot of time going out to hire new people on an annual basis, but I think the biggest benefit that we've been able to leverage by virtue of our staff's longstanding tenure here is that all of them have built really meaningful relationships with our clients. And so, it's often the case where we have a client that's been with us since the 90s, and they could probably care less. I don't want to overstate that, but they would care if the advisor left, right? But it's one of the account administrator, right? This person can leave, but never have the account administrator leave, because they know everything about my financial life, and they're always looking for a way to go above and beyond and help me in whatever problem I'm dealing with for that day. And so from an operational standpoint, the secret to our success has certainly been our staff.
That's a fantastic answer there.
And so, Jimmy, let me ask you this. Can you share some of your insights on, what the future of the firm is there? Where do you guys plan on being in 5 years from now? Do you guys continue to plan on growing the same way that you have? Is there a G2 in place? What's on the horizon for Kanawha?
Yeah, it's a good question. I think we would be comfortable continuing to grow the way that over the next 5 years, the way that we've been growing for most of the past 3.5 decades. And again, that's just by putting our clients first, taking on new business as we feel like we can, and still make every single one of our clients feel like they're our only client from a service standpoint. And so, what do we need in order to do that? Maybe we'll add another portfolio manager to be able to work with a greater number of clients while still offering that level of service. We certainly might add additional back office staff, again, to help meet that capacity. It will really just be a function of what our client growth is like, and where can we leverage technology in order to help increase our own personal efficiencies, and where can't we, where it might make sense to add someone else. Would we continue to grow strictly organically? We're certainly fine doing that. We don't have a problem with growing organically because we've seen pretty robust growth by doing that. But at the same time, I think that we'd be open to bolting on another advisor if there was a really nice match of culture and investment philosophy.
Cool.
And looking ahead, what do you see for the future of the industry? Amidst rapidly technology advancements every single day, evolving client preferences. What do you see there with technology? Any really trends shaping the future of the industry?
It's a really interesting question. I think one of the fears is that our industry is going to be subsumed by more of an AI-driven robo-advisor type platform, and some of those exist today. In my view, I think that that's not quite the threat that some people make it out to be. Money's very personal. It's
I totally agree.
Yeah, and next to maybe your health, there's probably nothing else that gives so much potential for anxiety as your money. And until we're ready to have an AI fully in charge of operating on us, I don't think that people are going to be comfortable with anything other than a human sitting across from the table from them and talking to them about their portfolio and their specific finances.
Yeah.
That's not to say that AI can't be a very valuable and contributory tool in helping the humans like us do our jobs. And I think we've seen over the past 10, 20 years, technology really democratize our industry in the sense where it used to be a binary decision for an investor. You could either work with the big bank that has all the resources and the research and the impressive tools, but maybe you're a small fish in a big pond, or you could work with a smaller firm like Kanawha, and maybe that firm would have limited resources and wouldn't have access to all the things that you need for the best portfolio. If that was the case 20 years ago, it's certainly not the case today, because we have the technological and research tools that all of the largest and best financial institutions have. And so we're able to bring, you think about the tools versus the service. We want to live at the intersection of those two things, not just offer the tools, not just offer the service, but offer both.
Yeah.
Yeah. And so shifting gears a bit, focusing on investments, Jimmy, any particular investment avenues or sectors that are currently igniting your enthusiasm right now, and anything that sets them apart to be potential generators of wealth in the future?
This is probably a pretty obvious answer. I'm certain you've gotten this before, but AI stands to really enhance every sector across the U.S. economy. And I think the market is buying into the notion that it's not just a tech sector phenomenon. Everything from increasing the efficiency of manufacturing supply chains, helping doctors identify diseases on x-rays and other imaging more effectively and potentially earlier. There's really no industry that I can think of that's not going to benefit from large language models and other sources of AI improving and enhancing productivity. And when we think about, what grows an economy, it's the labor plus the capital, right? Those historically have been the two primary inputs in determining what drives GDP growth, what drives the earnings of companies. Well, the wild card was always technology, right? And to the extent that technology could improve the output from a fixed amount of labor and capital, then that would be a benefit to that business. And I think that AI is probably the biggest leap forward in terms of that technological innovation that we've seen, at least since the internet and potentially even before the internet. It may be overhyped in the short run, but I tend to think that it may also be underappreciated in the long run. So we'll just have to wait and see.
And let me ask you this: what do you see as far as, are there any alternative investments that you guys are excited about right now that piques your interest? Commercial real estate, residential real estate, any opportunities that you could tell our listeners about and ourselves that you see?
Yeah, I think that's a fair question, and opportunities outside of stocks and bonds certainly can provide attractive return streams. Our firm has always been very, you could say plain vanilla in our approach, where we've stuck with investing in traditional stocks and bonds. We've tried to stay away from investing in new asset classes and alternative asset classes unless there's really a need to do so. I think that maybe back before 2022, you could have made the argument that in a low interest rate environment, maybe bonds weren't the diversifier that you otherwise thought they would have been, what a textbook would have told you. If that was the case then, I think that's less so the case now. I think it's a really exciting time, not only to be a financial advisor, but also a recent retiree. Because if you go back to pre-2022, the traditional 60-40 portfolio is essentially dead. You couldn't expect to get any meaningful source of return from the bond part of your portfolio, what we mean by that 40%. And that's completely different today, just with rates where they are. Obviously, there's a difficult path to get there, right, during that rising rate environment. But now that we're here, I think that stocks and bonds, exclusive of anything else in the industry, offer more than enough opportunity for the vast majority of investors to meet their specific goals. And so that's what we know, and that's what we stick to.
Yeah. And finally, let me, get your opinion on the economic outlook. I mean, we've had so many unprecedented events take place over the last couple of years with, our debt and, interest rates, big fluctuations, especially, the 10-year treasury going all the way down to what was it, 0.5 or 0.6 down in 2020 to us, at almost 5% again. I told you about, my past in my past experience in the mortgage business. I got in the mortgage business when interest rates were at 9.5% or 10% in the 90s. It was 1994, I believe I started in the industry. I chased the interest rates down from 10 all the way down to 2, and that's when I had gotten out. I would have never guessed that they would have shot back up to where they're at right now. And for consumers out there, what do you see as the future of what's going on with these interest rates? You think they're here to stay? What's your economic outlook?
I think it's a low probability that we get back to the bargain basement interest rate opportunities that we saw back in the wake of the pandemic and the monetary stimulus that the Fed pumped into the economy at that time. I wouldn't rule it out, again, because I'm not an economic prognosticator, but I just think that it's unlikely that absent some big exogenous crisis that there's a need to throw that much monetary stimulus at the economy. I think the Fed and most economists would acknowledge that where monetary policy is today is, all things equal, relatively restrictive. And part of the reason why we are still there, instead of having seen rate cuts this year, which is what 6 months ago many people were expecting, is because the economy is so strong. And I get a little bit frustrated when I hear bad news is good news in the stock market and vice versa, because it typically will portend bad news means that monetary policy will become accommodative and rates will come down. I think that in the long run, we want good news to be good news, and I think we should be very happy with the strength of the economy right now. Very strong labor market, very strong consumer. Things may be cooling a little bit from where they were a year and a half, 2 years ago, but still remain very strong. And of course, the only negative about that is the fact that the Fed both feels like they don't have to loosen policy because things are still so strong, and because that last percent of inflation to get from 3 down to their target of 2% has proved to be a pretty difficult last mile to traverse. And so that's keeping interest rates higher. But again, the market has been very resilient in the face of where the federal funds rate has been for several months now. And I think that part of that is attributable to a very strong economy.
And lastly, let me ask you this: when in talking about that, we've had another, first we've had the Russia and Ukraine, and then Israel and I don't know why I can't think of Palestine, and then obviously now my people from Iran and Israel. But do you think that's going to affect the markets at all? I mean, the markets had a little bit of a reaction the other day to it, or do you think that we keep marching? That if it's not something that's dealing with America, the stock market continues to do what it's doing.
Yeah, I think that the impact of geopolitical developments on the markets is one of those things where it typically doesn't really have a big impact until it does. And almost like a frog in a boiling pot of water phenomenon. And I don't mean to suggest that that's a one-way path that we're on right now, but it does seem like, over the past couple of years, really, you could bookmark it with Russia's invasion of Ukraine. The norm that we've begun to accept in terms of what can happen from a geopolitical standpoint, and it just feels like par for the course for us, has gotten more extreme over that period. And so that concerns me a little bit, because I think at a certain point, the global financial system, begins to feel more disrupted by the level of uncertainty that all of these different conflicts are injecting into the picture. And so I don't want any viewers or listeners to get the impression they should be overly concerned about any one event. But I do think that the long-term trend of just a less cooperative global community is certainly not a tailwind for stocks, and it could be a headwind.
I agree.
Interesting times ahead for sure. Well, Jimmy, I think that concludes our conversation. That concludes our conversation for today. Thank you so much for joining Mike and I on the show and sharing your insights with us and our audience. It's been an absolute pleasure having you on the show. We're excited to see what's ahead for you and your firm.
Thank you, Ashley. Thank you, Mike. I enjoyed the discussion, and I hope that your viewers and listeners did as well.
Thank you.
Thank you. And to all listeners, thanks for tuning in to another episode of the What Matters podcast. Remember, success is not just what you achieve, it's about the impact you make along the way. Until next time, stay curious and stay informed. Thanks, everyone.